I want to get you over now to a press conference. This is an event that's happening as well. This is it is federal financial leader Jerome Powell. He is speaking at a bankers conference right now. Let's go ahead and listen in live on Live Impact News on WCNC Plus.
Well, saying other.
Daryl?
Yes, Hal.
So I understood the question basically was, let's get rid of the Volcker rule so we can have more prop trading that could actually help the Treasury market. It's the implication. Okay. Okay. So, I understood why we did have the Volcker rule. It was kind of a populist measure back at the time when Scott Brown got elected in Massachusetts. So I remember the Senate hearing on this and the Democrats being puzzled about why we were even doing this. If prop trading would help the Treasury market, I would be in favor of re-examining the Volcker rule. But I want to caution everyone as we talk about all these changes, there is legislation to consider here. This is not something that the Fed or other regulators can easily do on their own. A lot of these changes are embedded in statutes, okay? Now, maybe the president can be creative with executive orders in this area, but as we proceed on this line, we have to ask ourselves, how much can the regulators do without legislative change? And that's a big constraint, okay, in this picture.
Just to be clear, in the legislation, the Treasury market is exempted from the Volcker rule, so it doesn't really restrict proprietary trading in the Treasury market. So let's have another question.
Daryl.
That's not true? Treasury securities are not exempted from the Volcker rule? I think they are.
It is.
Al?
Daryl. All right.
Sorry.
Norbert Michelle, Cato. Hi.
Yeah.
Sort of an efficiency question along those same lines. If we're worried about specific activities, okay, and if we're worried about source of strength actually being source of strength at the holding company level, why aren't we more worried about the capital at the IDI level as opposed to holding company level?
So let's revisit that. Anyone have a reaction on this issue of capital at the insured depository versus the holding company? Ben, you have your
Yeah, I think capital at the insured depository institution level is a relevant consideration, but we're looking at it today from a level that's high based on a leverage requirement that's also uniquely applicable at the GSIB IDI level, which is just not aligned with the general framework that we currently have. And so it is important to balance what's at the holding company, what's at the bank. And as I was expressing earlier, I think this rule would strike a better balance, but that doesn't mean that going lower is forever going to be a better thing. It's that it's necessary to balance all these things. So it's that this rule strikes a better relationship with the broader framework, in my view.
Okay, I'm watching for hands. I'm also watching the time. We have a couple more minutes. Yes, now Al.
Sure. Thank you. Al Moffat, J.P. Morgan Chase. So there's been a lot of discussion just early about the role of the leverage ratios as it relates to the Treasury market. And one thing I haven't heard from the panel is the effect on deposits. And so one of the things we saw during the periods of QE was that there was significant growth in deposits prior to the Fed rolling out the overnight RRP program. And strikes me that the changes to the leverage ratio may, reshape that into a potential next crisis. So I'm just wondering if the panel has any thoughts on the role of, particularly the value of changing the SLR for the IDI and the consequence on deposits and other low-risk activities like that, even if they are put into cash and not 30-year Treasury bonds. And just, maybe that potentially offers flexibility for the Federal Reserve in the size of the RRP program. But welcome any thoughts.
Who has a thought about this? Ben.
I was going to say the economic analysis of the proposal makes very clear that just in the past years and probably over longer periods, the degree of low-risk assets, treasuries, reserve bank deposits are much higher now than they've been in historical past. And I think that's important for the ESLR. It's also important for the basic Tier 1 leverage ratio. They have 4%, 5% structure, and the prompt corrective action framework's been around for a very long time. When it first was implemented, would be very confident that reserve bank balances and treasuries were a much smaller portion of bank balance sheets. Thinking about the overall structure of the capital framework, looking at the evolution of bank balance sheets, the degree of low-risk activities that are related to deposit taking, liquidity risk management, I think it's a very important consideration.
Tiffany.
I agree. As you mentioned now, heightened cash balances, heightened deposits, particularly in a period of stress, it typically coincides with when also Treasury intermediation is important. But ensuring, which is why we talk about a targeted approach that specifically excludes cash, for example, because banks tend to be that shock absorber of cash and deposits, whether it be in the immediate stress or afterwards as a result of monetary or fiscal policy. And banks having the ability to support that in periods, particularly volatility or stress, is important. And I agree that both supplemental leverage ratio as well as the Tier 1 leverage ratio should also focus on that.
Yes, and I think just to reinforce that, making sure the leverage ratio doesn't impede the banking system when the Fed is doing QE and adding to those deposits that you were talking about. And that's at the Bank of England. We exempted deposits at the Bank of England when we wanted to make sure that was so. I think so. As I said, I would be opposed to exempting Treasuries blanket, but I think thinking about exempting deposits at the Federal Reserve from the denominator, along with the other things, is worth consideration.
And that's a good point in that the PRA has made that exclusion as well in their leverage ratios, specifically for cash.
If I could, I just have a quick add-on that ought to be part of this discussion, and that's FDIC insurance on size of your balance sheet. They're the only measure still left where you go period end. And so one of the reasons you see repo get very tight at the end of a month is simply because everybody's calculating their balance sheet on period end. If they averaged it, you'd likely get rid of the month-end crunches. It seems to be a pretty easy fix.
Good to know. Okay, so we've run our allotted time. I just want to thank the panel for an extremely illuminating discussion. Lots of back and forth, good audience participation. I learned a lot, and I want to thank Vice Chair Bowman again for inviting us to speak here today. Thank you.
And you've been watching live right now. Fed Chair Jerome Powell speaking at that large banks conference, and they're taking a break. We will take a break as well at 10 a.m. Straight up here, you're watching Live Impact News on WCNC+. Thanks for having the app on your smart TVs all over the place, at home, at the office, at your doctor's office, and letting them know that we are here bringing you the live feeds, taking you from a local level all the way around the world. And as those feeds come in, we bring them to you in real time, as much as possible.